A sudden decision by a coalition of oil-producing nations, commonly referred to as OPEC, has sent shockwaves through the global market. These countries have opted to cut back on oil production, reducing the overall supply of oil available. As a result, prices have surged, much like how a rare delicacy becomes more expensive when it's harder to find. This calculated move is designed to protect the interests of these oil-rich nations, but its ripple effects are already being felt worldwide, making everyday life more costly for many. In the United States, the impact is becoming increasingly apparent. Rising oil prices mean that everything from fueling cars to transporting goods is getting more expensive, creating additional financial strain on families and businesses. Some experts worry that if this trend continues unchecked, it could lead to a broader economic downturn or possibly even trigger a recession. In response to these challenges, the U.S. has turned inward, tapping into its vast reserves of shale oil, leading to record high production levels. However, this strategy comes with its own complexities. Extracting oil from shale is more expensive than conventional methods, making the sustainability of this approach uncertain, particularly if global oil prices fall in the future. Meanwhile, another transformative shift is underway with the rapid rise of electric vehicles, EVs. As millions of EVs are expected to hit the roads in the coming years, many nations are planning to phase out traditional gasoline-powered vehicles. This transition could gradually reduce global oil demand, pushing oil companies to rethink their long-term strategies. While the U.S. grapples with these changes, Canada is facing its own unique set of trade challenges. Historically, Canada and the U.S. have shared a close economic relationship, but recent American policies, such as imposing high tariffs on key Canadian exports like steel, aluminum, and dairy, have strained this bond. In response, Canada has been actively exploring new trade partnerships to reduce its reliance on the U.S. One promising initiative is the proposed CANZ-UK alliance, which would bring together Canada, the United Kingdom, Australia, and New Zealand into a unified trading bloc. This partnership would facilitate the free movement of goods and labor across borders, leveraging commonalities such as language, legal systems, and cultural ties to strengthen economic ties between these nations. While this alliance offers Canada a potential path to greater economic stability, questions remain about whether it can rival the deep-rooted trade relationship with its southern neighbor. Despite seeking new trade partners, Canada isn't abandoning its relationship with the U.S. entirely. Instead, it is working to diversify its economic ties to avoid being overly dependent on a single market. Trade deals like the Comprehensive Economic and Trade Agreement, CETA, with the European Union have already opened access to a market of over 500 million consumers, making it easier for Canadian businesses to export goods to Europe. By adding partnerships like CANZ-UK to its portfolio, Canada hopes to strike a balance, ensuring greater economic security even if tensions with the U.S. persist. Meanwhile, across the border, American energy policy is taking a surprising turn. Not long ago, U.S. leaders expressed little interest in Canadian oil, but the landscape has shifted dramatically. The U.S. is now rushing to revive the Keystone XL pipeline, a controversial project previously halted due to environmental and political concerns. The pipeline would transport Canadian crude deep into American refineries, many of which are specifically designed to process Canada's heavy crude oil. With rising fuel demands and fluctuating energy prices, the U.S. has come to realize just how crucial Canadian oil is to its energy security. However, the growing trade tensions between the two countries are far from over. In March 2025, the U.S. is set to impose a sweeping 25% tariff on a wide range of Canadian goods, from agricultural products to industrial materials. Canada, unwilling to back down, is preparing to retaliate with its own tariffs on key American exports, which could include agricultural products, consumer goods, and even automobiles. Some in Canada are even considering restricting oil and natural gas exports to the U.S., a move that could drive American fuel prices even higher. If Canada were to limit its energy exports, the consequences would be severe. U.S. gas prices could spike by 20 to 30% within months, making everything from filling up a car to running factories significantly more expensive. Supply chains could face massive disruptions, as businesses struggle to obtain the materials they need. Additionally, countries like China and India could step in to purchase Canadian energy, further reducing U.S. control over its energy supply and reshaping global trade dynamics. In the broader context, the U.S. faces an urgent need to craft a long-term strategy for energy independence. Merely imposing tariffs won't solve the underlying issue. The Keystone XL pipeline, once seen as a silver bullet for boosting U.S. energy security, still carries risks. While proponents argue it would create thousands of jobs, secure a reliable oil supply, and help stabilize fuel prices, critics highlight the environmental costs. Oil from Canada's tar sands is significantly more carbon-intensive than conventional oil, and the risks of spills and ecological damage loom large. With the original developer, TC Energy, stepping away from the project, its future remains uncertain. The possibility of Canada cutting off energy exports is more than just speculation. It could lead to a full-blown crisis. Without Canadian oil and gas, prices would skyrocket, factories would struggle to operate, and households in colder northern states could find themselves unable to heat their homes during harsh winters. The repercussions would ripple through major industries, affecting everything from car manufacturing to agriculture. Leaders on both sides of the border would scramble for solutions, but by then, the damage might already be done. As trade tensions mount, Canada is increasingly looking to secure its economic future on its own terms. The country has been making major investments in infrastructure to support new trade routes that bypass U.S. ports, developing pipelines, railways, and roads that connect directly to Asian and European markets. Canada is also accelerating its renewable energy projects, with solar and wind power expanding rapidly. Additionally, as the global shift toward electric vehicles gains momentum, Canada's rich deposits of critical minerals like lithium and cobalt are becoming more valuable than ever. Automakers may soon prefer Canadian minerals over Asian suppliers, further strengthening Canada's position in the global energy market. If Canada successfully reduces its reliance on the U.S., the effects could be profound. A more self-sufficient Canada would mean that U.S. tariff policies lose some of their bite, forcing American leaders to rethink their approach to economic relations with their northern neighbor. In the process, other countries might follow Canada's lead, reimagining their trade relationships and moving toward a more multipolar global economy. Ultimately, the question is whether Canada can truly take control of its energy destiny and build a more independent economic future. If it does, the U.S. may have no choice but to adapt to a new, more balanced North American economic landscape. The stakes are high, and the decisions made in the coming years could reshape the region's economic and energy dynamics for decades to come.